Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning, everyone. Hope everyone had a enjoyable weekend. Going to get started this morning. Lots to talk about. Lots of news taking place over the weekend. We're going to talk about financial markets. Going to talk about the news and the importance of doing what is most critical, which is maintaining a balanced portfolio. So today, September 16th, 2019. Going to get started this morning and just run a few quotes by you this morning to get us thinking positively for the week. Quote from Richard Moss: "The greatest gift you can give another is the purity of your attention." Ken Keyes: "Everyone and everything around you is your teacher." Winston Churchill said, "The price of greatness is great responsibility." And Eric Butterworth said, "Happy relationships depend not on finding the right person, but in being the right person." And Miguel de Cervantes said, "'Tis the part of the wise man to keep himself today for tomorrow and not venture all his eggs in one basket." And that's the quote I want to focus on today, about not having all your eggs in one basket. And something to think about here as we experienced this morning, a spike in crude oil. Hard to say exactly how sustained that price increase will be. But what we do know is that if we have all the news information at our fingertips, the unexpected is going to always happen. And even when the unexpected happens, it is still nearly impossible to predict its meaning. If we had all the news flow that had taken place year to date, I think very few of us would have surmised that we'd be looking at a market this morning where the S&P futures are up. S&P futures were down and are now approaching almost break even this morning. They are still slightly down this morning, but given the news flow, I think very few people would have predicted that. But predicting where the equity markets are this year and where the bond market is this year has even been a more challenging for the experts. Year to date, we're looking at the S&P up almost 22%, the NASDAQ up 24%. We're looking at international markets, foreign stocks up 14.8%, emerging markets up 8.8%, all of that happening while bonds are continuing to show positive year-to-date performance even after the pullback we saw last week. The 10-year Treasury is up about 8.5% year to date. The global bond markets are up on average about 5.8%, and munis this year, after last week's pullback, are still up over 6% year to date. And if you look at the news flow throughout the year, trying to keep in perspective what has happened and what we've collectively as a society have experienced, it's easy to Monday morning quarterback and explain why we are where we are. But the reality is that no one, no matter how bright, how intelligent, how prescient, can predict where financial markets are going. We saw this year, trade tensions between the U.S. and China have escalated as the year has gone on. I think very few pundits would have predicted we'd see such strong equity markets if they knew that we would see rising tariffs on Chinese goods, retaliation from China on U.S. farmers in particular, and also on Chinese imports of U.S. goods. If we were aware that at this point of the year we'd still be looking at no deal with North Korea. In fact, North Korea has launched some missiles in the last few months. If you knew that tensions with Iran were going to continue to escalate throughout the year after the U.S. had pulled out of the Iran nuclear deal, if you had known that Iran was going to launch a drone strike against U.S. military interests in the Middle East, and the U.S. was potentially going to respond forcefully. If you had thought about the killing of Jamal Khashoggi and the fingerprints of that killing, perhaps leading all the way up to the senior regime in Saudi Arabia. If you had been aware of the regulatory scrutiny that was going to take place of the major U.S. tech companies, Facebook, Amazon, Apple, Twitter. On top of that, you had the U.S. Reacting to the trade tensions with China by banning Huawei products, initially banning the sale of U.S. components to Huawei, one of the largest Chinese companies. If you knew about Brexit, Theresa May resigning, Boris Johnson becoming Prime Minister, Boris Johnson not getting his way with the UK Parliament, hard Brexit still set for October 31st, virtually no progress taking place within the United Kingdom on Brexit. All those issues were amongst the largest issues of the year. If you think about the Federal Reserve and the tension between the Federal Reserve and President Trump, recently calling the Federal Reserve boneheads. If you thought about the shootings that have been taking place throughout the United States throughout this year, tragic shootings, horrific headlines. We've also seen some key departures from the cabinet of the president. Despite all of that, all those facts, all those factors, we are seeing both the stock and bond market significantly higher. Going back to the quote from Cervantes, where he's talking about not putting all your eggs in one basket, emphasizes the importance of a diversified portfolio, of a portfolio that is constructed with the intent of meeting each individual's goals, needs, desires, so that they can psychologically weather the storms that the media presents to us day in and day out, in order to have that portfolio built and battle-tested, not battle-tested for any outside factor or for any outside market, but battle-tested for each individual's own psyche, each investor's own risk tolerance, so that the portfolio they create is a portfolio that they can stick with and make adjustments and fine-tune, but not to make rash decisions upon headlines and news flow, where we as humans think that this news flow is going to be a game changer, a seminal moment, and almost always, not always, but almost always, the news flow is not a seminal event. It is not another 2008. It is not another Pearl Harbor. And we react to each of those events as if they are those defining moments, when those defining moments happen far more rarely than we as humans ascribe to our emotional states and how we react emotionally. So, working with a financial advisor, great way to temper some of those impulses and urges that every investor, no matter how professional, feels when the emotion hits them. And today we get a reminder of just how those news flows can be jarring. Over the weekend we saw that there were some military strikes against Saudi oil facilities. And as a result, we have tensions in the Middle East escalating, where the U.S. Is accusing Iran of being behind those attacks and suggesting that we may initiate military action if there's further proof or evidence of that. And we're seeing oil up $5.59, up 10% this morning. Gold is up $11.60 on that flight to safety. And we're seeing U.S. futures now down just 91 points, as I mentioned earlier. Perhaps you're smarter than I am, but if you had seen those headlines, you may have thought that we'd be looking at more of a sell-off. Also, on top of that, you got the news this morning that General Motors going on the first auto strike here in the United States in a dozen years. Since 2007, 48,000 hourly workers heading to the picket lines. Also reports that China's slowdown is deepening, industrial output falling to a 17.5-year low, and of course, no one knows where the rest of the weekday year plays out. But nevertheless, again, re-emphasize diversified portfolio, not all eggs in one basket, and I think that will lead to the most success. We're going to change gears back to mindset, how psychologically how to approach not only investments but different aspects of one's life, and one of the aspects that may help investors think more clearly, but perhaps each of us to think about different aspects of our life with more definition, and that is by trying to have thanksgiving. Or thanks towards the good. Looking at 3 ways to practice thanksgiving or to be thankful. The first is to search for the good and to recognize it and to give it praise. Could be in the good that you see in your spouse, your children, your coworkers, anyone that you're interacting with. We tend to attract that which we give our attention to. Where your attention goes, your energy flows. A second way to experience thanksgiving is to give thanks ahead of time for whatever good you desire in your life. Feel as if you already have received this good. Thoughts held in mind will reproduce in the outer world after their own kind. And finally, the third way to experience thanksgiving, perhaps the most difficult yet the most powerful of all, is to give thanks for your problems and challenges. By facing challenges and overcoming them, we grow stronger, wiser, and more compassionate. One of the best ways to prepare for an athletic event is to practice with a strong, competitive opponent. Adversity, when overcome, strengthens us, so we are giving thanks not for the problem itself, but for the strength and the knowledge that will come from it. Giving thanks for this growth ahead of time will help you to grow through, not just go through your challenges. So moving on to where we are specifically this morning, a couple of other news stories, and then talk about some stories in Barron's. So with the tensions here in the Middle East, Saudi, to be specific, Saudi Aramco suspended 5.7 million barrels per day of oil output. They said they intend on restoring 33% of lost output on Monday, which is today. Reuters is reporting it will take months for Saudi Arabia to resume normal production. The gains in oil prices have been somewhat mitigated after President Trump authorized the release of oil from the Strategic Petroleum Reserve. President Trump said the U.S. is locked and loaded depending on the verification of the culprit, raising concerns about a military conflict. Secretary of State Mike Pompeo said Iran was behind the attack. Oil-sensitive stocks are extending gains. Airline stocks are experiencing weakness as they have a major component of oil and jet fuel. ExxonMobil is up about 3% this morning, a little over 2 points. Chevron Texaco is up about 4 points, a little up over 3%. Airlines in general down 3 to 4%. So the inverse of what we're seeing in the energy space. Bond market, which initially didn't have much of a reaction, but now we are seeing a little bit more of a flight to safety. We are seeing bond prices higher. The 2-year yield is down to 176. That's down 4 basis points. The 10-year down 5 basis points to 185. And the 30-year down 6 basis points to a 231 this morning. Move on to a couple of other stories. Barron's this morning talked about the strike at General Motors, and they also talked about the spike in energy prices. Those of you who are students of history are probably aware that 5 of the last 6 recessions have been preceded by higher energy prices, so certainly higher energy prices, grave source of concern if they are sustained. Goldman Sachs out this morning saying if the Saudi production is not put back online quickly, they think that oil prices potentially could go to $75 per barrel. Russia out this morning saying that they are not immediately increasing their production of oil. Nevertheless, Barron's this morning saying that if this oil spike is offset by things like the release in the Strategic Petroleum Reserve, and if production can get back online in the next month or two, they saying that it will take more than this oil price strike and the General Motors auto strike to derail the U.S. economy, suggesting that the weakness or the effects of these outside events could be somewhat offset by some of the coming interest rates cuts that are being anticipated from the Federal Reserve. as well as the fact that the U.S. consumer remains strong, and if the U.S. consumer views higher oil prices as a temporary event rather than a permanent event, then the U.S. consumer will hopefully stay resilient and continue shopping. Going on this week, some of the bigger events this week. On Thursday, the Bank of England and the Bank of Japan announced their monetary policy decisions. Both central banks are expected to keep their key short-term interest rates unchanged. That's at 0.75 of a point or 75 basis points in the UK and negative 0.1 in Japan. Thursday, we get the Conference Board releasing its economic index for August. Expectations are for a 0.1% rise, after a 0.5% increase in July. Leading economic indicators and a positive momentum in that economic report is something carefully watched for those who are on the lookout for a slowdown. So expectations of that modest rise still anticipated. Also on Thursday, we'll get a peek at the U.S. real estate market, see if the lower interest rates have been helping. The National Association of Realtors reports existing home sales for August, and they are expected to be even with July at 5.4 million homes being sold. Couple of stories from Barron's. Barron's talked about Apple and Apple TV, and we're getting a broad disagreement on the effects of Apple TV Plus. We have Goldman Sachs last week out skeptically about Apple TV's pricing of Apple TV Plus and the concerns about margins and cutting their price target to $167. Other analysts, including analysts this morning at Evercore ISI, raising their target on Apple, viewing the Apple TV Plus product launch as a positive. So we have a real tug of war. Barron's falling in the camp with Goldman Sachs. They said that the only thing that mattered with Apple TV Plus's service was its price, which came in unexpectedly low at $4.99. They'll also be providing Apple TV Plus for 1 year free to anyone buying a new iPhone, iPad, Apple TV, or Mac. That price pressure put pressure on some of the competitors in the streaming space. Disney and Netflix both fell over 2% on that announcement. In fact, this morning, Bob Iger, the CEO of Disney, resigning from Apple's board because he's acknowledging the competition that's coming between the two companies in a very head-on fashion in the streaming space. Barron's, in their opinions, saying that the $4.99 a month price for Apple TV Plus looks appealing, but it may not be so attractive once consumers consider the number of shows the service will offer. Apple News listed 9 shows to be offered at launch. That is significantly less than what Disney and Netflix offer. The analysts who are positive on the stock have a different take and view the $4.99 price as a price that will bring in a mass amount of subscribers, even though there will be a skinny amount of product available. But by that low price and by providing it free to purchasers of other Apple products, they feel that they can build up an installed base and take a page from the Netflix playbook, where over time they build out their distribution and their products, and then they systematically go about increasing the price as the service improves. Time will tell, of course, who is right in the streaming wars and the streaming strategy. Also, something to look at this week. Actually, not this week, but this over the next month. And that is the SEC is investigating a handful of Bitcoin ETFs that some speculate some or one may get approval. There are a few ETFs that the SEC has set target dates on when they will be issuing a final decision. One from Bitwise, the SEC said they will decide on October 13th if a Bitwise Bitcoin ETF trust will get approval. And Van Eck also seeking approval with a tentative deadline of October 18th for a Bitcoin ETF. And finally, Wilshire will be the first to hear on September 29th if the SEC may grant approval for their Bitcoin ETF. some of the factors that may sway the SEC's thought process from previous rejections of Bitcoin ETFs is that the Bitcoin trading volume has grown significantly to about $1 billion a day, which is volume that makes it more difficult for players to manipulate price as volume goes up. It gets more challenging to manipulate price. So we'll see if there will be a Bitcoin ETF with SEC approval. I'm going to speak a little bit about interest rates and the bond market. Lots to talk about. We've seen a wild ride as interest rates literally plummeted over the last several months, and then we saw at least going into the weekend at least a percentage on a percentage basis, a significant change in the price of bonds. And we saw yields tick up as prices went down, some suggesting perhaps the yields had just gotten too low. And also we started to see some inflation numbers that perhaps were causing concern and causing participants to question, again, this is before the events of today, whether or not the Federal Reserve was going to meaningfully continue to reduce interest rates. Jim Grant, who has been skeptical of the bond bull for at least the past 12 months, perhaps longer, wrote an article in Barron's, and basically he stopped quoting himself because he knows that his readers are well aware of his views on how low interest rates are and how concerned he is about it. And he talked about instead an article recently written by the head bond strategist at BlackRock, Rick Reeder, who has not been as Pollyanna or concerned as he has, and he quotes from Rick Reeder of BlackRock headline saying President Trump on Tuesday morning of last week issued an ultimatum to the boneheads at the Federal Reserve to do something to materialize negative nominal interest rates. And Rick Reeder said that prompts the question, where does it all end? And he then gave his opinion in monetary debasement, a bond shakeout, and higher gold prices, of course. He went on to say, as is probably evident, any nominal instrument, which is things like paper currencies, will be devalued in real terms. So he said the solution is to hold an asset that maintains its real value. That's an asset that cannot be printed. What he is suggesting investors hold on to are stocks that pay dividends, that are invested in companies that have pricing power. So if you do get inflation, they can raise that. He also suggested considering real estate because real estate is something that is not there's not much more of that being created out there. Nature created the amount of real estate that's out there, so supply there not going to increase. And he talked about commodity currencies like gold, again, limited supply and expensive to extract. He said the worst asset to hold in this environment is a sovereign bond with a negative yield, followed closely by paper money at zero yield, both with theoretically infinite supply. In a separate article, Barron's talked about the European Central Bank meeting last week where they cut interest rates in Europe by 0.1%. Europeans also, Mario Draghi, being called Count Dragula in the European Union, but Mario Draghi saying that they are going to resume quantitative easing. ECB is going to purchase up to 20 billion euros, about $22 billion in U.S. currency a month of European assets. But both Jerome Powell here in the U.S. and Mario Draghi in the ECB somewhat suggesting, in a fairly beyond somewhat suggesting that this is about all monetary policy can do. The U.S. has been very aggressive in fiscal policy, and that's evidenced by the $1 trillion deficit that the U.S. has so far amassed this year. But Mario Draghi and others in Japan suggesting that the European Union and Japan need to increase their fiscal spending. They've been very fiscally prudent, at least in terms of their spending, and perhaps overly cautious. Even Germany is considering establishing an agency to finance infrastructure and climate change debt. And this was the reason they need to create these agencies, is because the Germans have very strict laws built into their constitution to not allow deficit spending for sovereign debt. So perhaps an end run here, even in Germany, where the memories of hyperinflation are still very sharp. Japan is also moving to fiscal stimulus. Prime Minister Abe is considering a second round of consumption taxes, and this is something that also could lead to put together here more money supply if both these countries go about this fiscal spending. When I say both these countries, the ECB, which is not a country but a block of countries, and Japan. All that playing into Rick Reeder's concern about the uncertainty about paper currencies, but the evidence is building. The final conclusion, of course, remains unseen, but evidence building that monetary policy seems like the proverbial pushing on a string may in fact be taking place. And finally, I'm going to give a plug here to Brad, who's been talking about buying kicker bonds. Keith Douglas sent a article that was in Barron's to Brad and myself over the weekend, where analysts had suggested that among his favorite investments are high credit quality municipal kicker bonds. This is something that Brad's been talking about for the past several months at this point. So here a top strategist endorsing what Brad's been saying for some time. Kicker bonds offer strong yield to compensate investors for uncertainty about their call date. They get their name because the yield received by the investor increases or kicks if the issuer declines to buy them back when the call date arrives. The investor here, similar to Brad, recommends very high quality bonds when you're purchasing kickers, especially because you're paying that premium. He recommends essential service bonds like those to pay for tunnels, bridges, airports, sewers, water systems. And kicker munis have an unusual price structure that frightens off some individual investors, and he says that creates opportunities for those who understand them better. The author in this article also likes another sector I think favorably of, which is preferred stocks, which pay a fixed dividend. They are preferred stocks because they are preferred, more senior in the capital structure than common stocks, although they are subordinate to debt or bonds. Aside from the attractive yields that preferreds offer, which are somewhere in the neighborhood of 5%, depending on the issue, most pay qualified dividends, which are taxed at a top federal rate of 23.8% versus 37% on income from corporate bonds. What's more, current supply and demand dynamics bode well for preferred's price potential. Financial institutions, banks are the biggest issuers, and they have scaled back issuance over the past several years, and this is a result of some of the changes that have taken place in the rules regarding how banks can view preferreds from a capital structure and what's good capital, what's not. So banks have been issuing less preferreds, less supply, perhaps yielding opportunity to get higher relative yield to some of the competitors to preferred stocks, and also at the same time get that more attractive tax structure. Especially when you're looking at accounts that are not qualified accounts. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.